Kitco Mining's special coverage of the Precious Metals Summit is brought to you by New Core Gold.
Gold is starting to stretch its legs. Hello and welcome to Kitco Mining with me, Paul Harris, here at the 2025 Precious Metals Summit in Beaver Creek, Colorado. Joining me today to discuss this is Tavi Costa, partner and macro strategist at Crescat Capital. Tavi, welcome back to Kitco.
Thanks for having me. Yeah.
We have a lot of things to talk about. It's been a very exciting time. I prepared my notes at the weekend and they're already out of date. The gold price and stock prices are moving so fast. You pointed out on X recently that for the first time since 1996, foreign central banks hold more gold than treasuries, as gold share of global international reserves continues to increase while the US dollar continues to fall. Why is this a big deal?
There's so much to unpack there. I think, first of all, foreign central banks, I think the biggest research piece that came out of this analysis actually comes out from the fact that central banks, if you break down foreign holdings of treasuries, central banks specifically, which there's an index that covers that, you can see they have been actually selling down nominally. And who has been actually buying those treasuries has been most of the private institutions and others that are not government related. And so when you see this private central banks really accumulating gold to the degree that we're seeing right now, and most importantly, when you go back to the 70s or so, we're close to 70% of gold ownership relative to their balance sheets. I think we're just getting started. This is really exciting. It sort of, in my view, points to a direction. If you think about it, I mean, there's really two ways they can get back to those 70 levels. And one is accumulating gold, and another would be revaluing gold at crazy, prices that we probably shouldn't be talking about here. But and so I do think this is the beginning of a bull market. We're still just starting to see the performance of the risky parts of the gold space. The miners started to respond in a large way, but on a relative basis, I think we're just getting started in that trend. So it's very exciting. It's nice to see flows of capital back into this industry, and but nothing feels like any frothiness at all.
Okay, I want to talk about the miners and the juniors in a moment. We've got a lot more to get through, I think, on the macro stage first. One of the key drivers, or some of the key drivers behind this trend are the emerging market countries wanting to get away from the US dollar and US dollar hegemony, US government hegemony. We're seeing a lot of geopolitical risk. There's war in Ukraine, there's war in Gaza, there's missiles being dropped on Qatar, there's drones flying over Poland. It seems a very unstable situation out there.
Yeah, I think it's a reflection of how much debt is in the system. I mean, debt creates wars, and I think we've never seen this level of indebtedness. The U.S. is facing a very difficult dilemma, if I would say it that way. It's just we've never seen structurally a deficit issue, not only the fiscal side that everybody talks about, but the trade side as well. And the two together exponentially grow the debt side. And so that chart that we were talking about just a moment ago does not include the U.S. And so, the U.S. could be part of this accumulation at some point. Maybe it is already. Who knows? None of us know. And the other point of this is that that's official data that is reported. Who knows what's happening, off the radar. So I do believe this is a profound change in the macro landscape and probably here to stay. This is not, this is probably in the 1970s. I love looking back in the 1970s, just more because of the inflation issues we had in that time. But this feels so different. I mean, the imbalances are just way worse. I mean, we're nothing close to those levels. I mean, you read those reports and they were concerned about deficits being at 0.5% of GDP or trade deficits being at 1% of GDP. We're talking, 5, 6, 7 times depending on what imbalance you're referring to. And so this is a real issue and potentially time to be seeing this compounding effect into the resources space that has been neglected for a long time. So,
one thing a lot of observers of the gold space seem to know or think they know is that the US Federal Reserve will cut interest rates at its next meeting. The only question is by how much, it seems. To what extent is that already factored into the gold price?
I think a lot of it, and I'm a little afraid that may not happen. I mean, there is definitely justification to believe that market might be a little ahead of itself on that view. And by the way, if I'm wrong, market is priced that in, and that's fine. But I like when you have that type of the asymmetry where there's definitely justification that the Fed could be taking in terms of the inflation data, and saying that labor data is a bit confusing to make a call. Inflation is reaccelerating from many fronts. You can look at the 10-year break-evens. You can look at the commodities in general have been moving ahead. And gold itself, I mean, it's an inflation signal as well. And so certainly that has been happening. And even on the government data, I mean, if you just want to dive into just government data alone, which we can argue the legitimacy of that, that is also accelerating in a large way. So the Fed can certainly take the point of perhaps not lowering rates as Trump is asking. We saw that in the 60s, you know, that fight between the Trump administration or the president versus the Fed chair happened in the late 60s as well, in 1968. When LBJ was fighting the Fed chair at that time. And he raised rates, actually, and he went to his ranch, basically trying to fight the guy, asking to lower rates. And so ultimately, we're going to get to a fiscal dominance state where lowering rates becomes almost an unavoidable policy to allow the government to not go broke, essentially. And so we're going to get there. But I would, you know, I don't mind taking a contrarian view that there is justification that the Fed may not lower rates in this next meeting. But so there you have it.
I think that's an interesting point, what you mentioned about the 1960s, because what you could perhaps call an oblique asymmetry factor today is the hostility of the US President Donald Trump against US Federal Reserve Chairman Jerome Powell for not lowering interest rates, and now he's perhaps extended that to one of the Federal Reserve governors, Lisa Cook, trying to get her removed from her position. Is this President Trump just creating noise, or is he looking to sort of knocking things to create change, affect change, create a reaction?
Well, I think so, but there's also, you know, you can look at two lenses. I mean, if you look at the Fed lenses first, they are in a position where inflation is reaccelerating. So if you're just looking at inflation alone, you should be actually raising rates. Look at the Taylor rule rate, which suggests, I think, 150 basis points of increasing rates. And that really takes into account labor and inflation. And so, we're starting to be way far off from the target of inflation. Now let's look at the Trump lenses. The Trump lenses is also right. I mean, he doesn't have a choice. At that time in the 60s, when the president was fighting the Fed chair at that time, he was basically saying, you were increasing the cost of my war in Vietnam at that time. And, here we're in a similar position where, we want to build up the country. There's a lot that we need to do for this AI revolution, onshoring. You can name a lot of different themes that may play out. And, how do you do that with rates at these levels? And so, certainly there's justification to lower rates on that alone. And so I think interest payments is way too high. We're imposing this in ourselves. And when you think about that, if we're going to be lowering rates, and I think a comment on this on X recently, and I do believe that the real Mar-a-Lago Accord that we're seeing is in the FX world. I mean, or I should say in the fixed income world. Look at the 10-year yields across the globe versus the U.S. rates. 10-year yields in the U.S. have been pretty much in the same level from the beginning of the year. Every other 10-year yield has been going higher. And that's really the support for the FX of those countries. So you're seeing the euro doing well, the Japanese yen doing well, even the Canadian dollar is having a good year. And so all those things are linked to the interest rate differentials, which I think are going to play a role here. So, well, Trump is going to have to do that. And it's not just Trump, it's going to be any president. Otherwise, we're going to probably have some emerging market issues in our debt problem here.
With these threats to the independence of the U.S. Federal Reserve, Goldman Sachs has said, for example, gold could rally up to $5,000 per ounce. To what extent or not do you think that's realistic?
Well, you've been in the business here as well for some time. It's a little bit scary when those banks start coming out with those targets, but there's some validity to that view. And sometimes it's okay to take the same point that those institutions have. And I do believe that we are in a world where you're suppressing rates and allowing inflation to run hotter than expected. Yeah, that's going to be extremely positive for hard assets. I think that gold has been reflecting a lot of that. The problem is some of the derivatives of gold are still trading like, we're just getting started in that world. And to me, it seems not there's nothing like certainty in markets. I mean, anybody who says that is you shouldn't be covering markets at all. But I do think that one thing I feel confident is that we're probably going to see a lower dollar in the near future. We're probably going to see lower rates, and we're probably going to see inflation is staying higher than expected. So as an investor, you want to sort of deploy capital in those camps and think accordingly. And so there's a few pockets of the market that are not reflecting that right now. Emerging markets, oil, agricultural commodities. Gold is doing very well. You can argue that silver is cheap relative to gold. The miners are cheap relative to gold. So all sorts of things you can express those views, but I think it's a world that, in that sense, is I think those constraints are real. So.
Well, let's turn to the miners. You mentioned the miners a couple of times, so let's turn to them. They've really started posting and showing the benefits of strong gold prices. The GDX Gold Miners Index is at a decade high. The NYSE Arca Gold Miners Index hit its highest level since 2011. Even Barrick Mining is starting to show some performance. With the miners starting to run up, is your thought, is this going to be a quick sprint, or is this more of a long-term marathon for them?
It's always a quick sprint. It feels like a quick sprint when we're in it, but I do think this is a long-term movement in the mining space. If you look at the mining index relative to gold itself, I think it's 60% below the 2011 levels. So there's a lot of room for that. In the technical, just looking at the technicals of that ratio, we're just getting it started. I suspect, and look, I don't have a crystal ball like anybody else, but I do think we have a 2 to 3 years window where miners should be outperforming gold. That doesn't mean gold is going to keep going higher and higher and higher or lower. I'm just saying that it's about time for the capital to start flowing into the mining space, even engagement of the government, but also you're starting to hear the crypto space is starting to get involved in gold, which is, not to name companies, but it's really interesting.
We can name it Tether. We had Elemental Altus on the show earlier, and we talked a lot about Tether and its investment into the space and what their plans are.
Fascinating. I think that's a fascinating story, and about time to see some fresh capital coming into this industry. So, look, I think this is very exciting. One thing I would say is that it's all an exercise of acceptance of risk when it comes to investing. Gold is the easy one to sort of understand, and there's so much volume, liquidity, history, analysis being done. Central banks are the largest owners. So, buying 2-3% of your portfolio in gold, it's somewhat of an easy exercise accepting that risk. Now, buying silver, copper, it's another story. Buying a royalty company becomes a little easier, but then a miner, you take an operational risk and you don't understand much about the resources and all sorts of things. And so we're seeing this risk curve increasing in appetite, and the acceptance of risk is certainly happening, and people are starting to even dive into exploration. Or think about a long duration play on gold. That's exploration. I love that segment of the industry, but there's so many parts that are starting to see liquidity, and I think it's very exciting. I think it's just the beginning.
We are at Beaver Creek, and obviously this is an event for the juniors, the non-producing companies, the explorers. The past couple of weeks have seen the GDXJ index hit a decade high. It's doubled this year, although when you look over a 10 to 15-year time horizon, it's hardly moved. It's still at very, very low levels. Are the junior miners and developers really starting to get some wind into their sails, or is that sort of hurricane yet to come?
Oh, I think we're still, the beginning of that trend. It feels so good given where we have been in the past and how depressed this industry has been. And so people in good mood, it just feels so different. But I do think we're probably into a decade long of this sort of environment. Of course, we're going to have, remember in the 70s, we had bear markets of over 60, 70% in the mining industry. And so, be very careful with your risk and managing those positions. One thing I would mention on that front of risk, because I think a lot about that, I have personally through the funds and all sorts of investments in the mining space, and I keep thinking, what's the hedge on that other side of your portfolio? And we talk a lot about, equity markets potentially having a fall and all sorts of things, but think about this. Energy is probably your best way to manage risk here. Energy companies in general are very cheap right now. You look at most metals relative to gold, those ratios, they don't tend to stay at those high levels, historically speaking, for too long. So if you're a mining company, you're not hedging that risk, energy risk to be specific, I think you're out of your mind. So I think it's a good time to be protecting your margins. I think they're here to stay, but energy is really cheap relative to metals. And maybe it's a good way to sort of appropriately think about your risk in your portfolio. So.
Well, that's right. The oil price is what, $66 per barrel? It's not that long ago. It was up near 100.
Yeah, and how much risk premium, or I should say, geopolitical risk is priced into that into oil prices right now? It's a very good question. I think there's none really, and we're starting to see the Permian and other. Just looking at number of drills operating in the U.S. are starting to fall. That usually is a leading indicator for production. Positioning for oil alone is one of the most bearish ones we've seen in the last 2 decades, and so you can kind of look into these things and say, well, there's a list of macro reasons to be long oil. And then just looking at technically a chart of most energy companies have been consolidating for about 2 to 3 years. I really personally like these types of movements where you have a big movement, 3 years of consolidation, nobody cares. That's the moment to be, investing, in my opinion. So.
One of the indicators for frothiness in the mining space and the mining stock space is M&A activity. And we've seen some big deals announced in the past couple of weeks. Big one is Anglo American, the $53 billion merger with Teck Resources, Elemental Altus royalties and EMX royalties. That's Tether's involved in that as well. They're providing $100 million of funding into Elemental for that. Barrick Gold sold Hemlo, announced that last night, $1 billion. And a company perhaps a little bit closer to you, Tavi, Newfound Gold, announced it will acquire Maritime Resources. There's a lot been said on the bigger transactions, so let's spend a bit of time on the Newfound Gold Maritime. What's the rationale for that deal?
Well, I'm not as involved with Newfound as I was a few years back, but I think the rationale back in the days when I was involved certainly was, the trying to speed up getting into a production stage of the company, and I think that is very strategic what they did. It was something that even us as investors were, contemplating at that time as well, and so it's nice to see. It's a very good move. I think the share price is potentially not reflecting the synergies that we may see out of this, and so it's actually very positive. In regards to M&A overall, I think that we're seeing a lot of M&A happen between large companies. We're not really seeing the large companies buying the small businesses yet. I mean, maybe a few cases, but in general, the money is staying at the top, and so we're not seeing that down the bottom. And I find that we're yet to see that part of the cycle. I mean, and most of the companies, as we all know, are depleting their reserves. Are probably going to be looking for the high quality juniors. We haven't seen that part of the cycle yet. And I think one thing we can say as experience of watching this industry for a long time is that cash in the balance sheets ultimately will find its way into acquisition. So I think owning high quality assets in the exploration and development phase is certainly a strategy to be taken. So I'm excited about that as well. The Elemental, I don't have much to share on that one, but I do love the freshness of capital into this industry, and I think it's interesting. I don't know what they're going to necessarily do and what the plans are, but it's interesting to see that type of money coming into the space. I think that it makes a lot of sense, and so I'm excited about. Well, one that you didn't mention, maybe that I should mention, is the MP Materials deal with the government. I know it was a while back, but when do we see these things? I mean, that's a very sort of wartime acquisition by the government. It wasn't a bailout. I mean, that was a strategic investment in a company. Can we see more of that? Yes, and there's a lot of questions on this. I'm not saying this is fully positive. I mean, that, governments will change every 4 years, maybe. They might stay for 8, but who knows? But
was that a Freudian slip about Trump's attempts to perhaps stay in power longer than he should?
Maybe, but not. But my point is that not even that, is that the equity stake will stay on these companies, and who knows how that's going to evolve. And so those are big. That's how this is not revolutionary. We've seen it. I'm from Brazil. I've seen this so many times in Brazil, and sometimes those equity stakes can turn out to be very bad things depending on how government wants to engage. And so all I'm saying is it's not all blue sky. There's some issues here as well on that front.
Okay, well, let's wrap up with a look into the future. What are some of the key things you're watching out for in the precious metal space over the next 6 months or so?
Precious metal space. Well, I'm looking out for a potential breakout of silver in the near term. I think this is the time to be paying very close attention to the metal because it's been moving along over the last weeks or so, while gold has been doing very well, but we're still gold to silver ratio at historical levels. I really think and feel very compelled that we're probably going to see new highs in the next 12 months in silver, and I think we're going to see levels we haven't never seen in history. I think the biggest challenge for precious metals investors, I mean, may sound a little bit of cocky or any. I really don't want to sound like that at all. But what I want to say is, we're all trying to compare prior cycles to this valuations and how to, what's the peak of a company value will achieve. And I don't think any of us have a clue of what this cycle is about to do. And mostly because the imbalances we're facing are way worse than the early 2000s, the 1970s. And so it wouldn't shock me at all to see valuations reach levels that we haven't thought about it. And so our biggest challenge as investors will be to hold on to those investments, in my view, and really see them come to fruition over time. I think that's going to be the challenge. We haven't even seen the generalists come in and start valuing these things with, complete nonsense ideas. And so that's still to come, in my view. So it's very exciting.
So buckle up that seatbelt.
Yes, that's what I try to do. Owning private companies is great because you can't sell, and so you just stay with them.
Brilliant. This has been wonderful. Tavi Costa, thank you very much for joining us today.
Thanks, Paul. Appreciate it.
And we have a lot more to come from the 2025 Precious Metals Summit here in Beaver Creek in Colorado. So hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.
Kitco Mining special coverage of the Precious Metals Summit is brought to you by New Core Gold.